bit on that front. Maybe there is more to go here. Pratik Gupta is our market master of the day. He's Chief Executive Officer and Co-Head Institutional Equities at Kotak Securities. Pratik, great to have you with us here on CNBC-TV18. Appreciate your time. How are things looking to your mind, Pratik? We are coming to the fag end of the earnings season. Any takeaways for you? How has Q2 impacted your full year estimates, that is FY23 as well?
Hi, good morning, Prashant. I think as far as earnings are concerned, we haven't seen too much of a change. If anything, we've seen modest downgrades across the board. Overall, for the year as a whole, for FY23, our earnings expectations for the Nifty are about 11%. And more importantly, for FY24 and 25, our estimates are running at about 16-17% for both the years as of now. With banks clearly still, that's the one space where we are seeing upgrades. Mainly due to credit cost provisioning coming down and loan growth picking up. So bank still remains our favorite place. But I would say, as far as the overall market is concerned, and we're seeing this right now today as well. One of the concerns we've had for a while is that India is really outperformed by a mile compared to other emerging markets this year. Just to put some numbers in perspective, India is up about 5-6% year to date, whereas China, for example, is down some 25-27%. The MSCI EM index is down about 25-26%. And we think we're getting to a point where valuations are really getting stretched. India is now, the Nifty is trading at about 19 times FY24 earnings, 17 times FY25 earnings. And the premium to MSCI EM is now gone up to 100%. So India has always traded at a premium, but this time around, it's gone way beyond the normal range of about 40 to 60%. So in the eyes of global institutional investors, as it is, while everyone sort of agrees with the longer term, medium term positive outlook in India, our demographics and the China plus one story, the fact that our banking sector is cleaned up, we're about to embark on a new credit upcycle, etc. But in the short term, we think there is a risk that India sort of underperforms, and we even worry about the risk of more foreign outflows as people shift money away from India to China. China, you might be aware today, there were some measures about property sector stimulus and a little bit on the COVID reopening strategy over there. So if that continues and that starts gaining momentum, we could see some money shifting out, especially in the context of India being quite expensive.
Right. By the way, just want to point out there's a big crack happening in the pharma space, as we told you earlier. Aurobindo Pharma is now down 6% at a fresh 52-week low. Divi's is at a fresh 52-week low this morning as well, and that stock has lost over 30% of its value this year. Big cracks, Natco Pharma at a fresh 52-week low, and Alchem as well has lowered its margin guidance. What do you see happening here? I mean, is it like, Pratik, is it more, a case of pricing issues in the US, higher US FDA scrutiny on many of these companies? Because across the board, we're seeing a major sell-off in pharma names. And what do you do if you're an investor?
Yes, on pharma, actually, we've had a sort of cautious view for a while. And now, given the price declines over not just today, in fact, over the last 1 week or so, prices are beginning to come off to somewhat more neutralish type of levels. But even now, I think in pharma, you have to still be quite selective. The underlying operating environment in the US is still not benign. Competitive intensity remains high. We are seeing pricing pressure on the US generics players. Meanwhile, the product pipeline launches for many of them haven't come through to the extent as expected. And the Indian pharma sector the Indian market is sort of just chugging along, no major positive surprises over there. And in one or two of these cases, there have been some corporate governance concerns as well. But by and large, we are sort of neutral on the pharma space. For investors who are looking at this space, we are actually recommending that they look at the hospital sector instead of the pharma sector, where valuations are middling, growth is sort of reasonable, nothing exciting. But the hospital space is something where we think there's a structural growth story over there. With the occupancy rates going up, with the bed expansion coming up, and also you have potentially a better mix of patients coming through with international medical tourism also beginning to revive. These valuation multiples for hospitals are generally a bit higher, but so are the growth prospects. So we're basically telling investors that don't focus so much on the pharma sector, focus more on the hospital space, not the diagnostic space. There we have intense competition from the online players, and there we're actually quite negative. So in the entire pharma and healthcare space, it's the hospital space we are recommending.
Hi, Pratik. Morning. Pratik, I wanted to ask you about the estimates you're putting out on the Nifty EPS growth. I think you're talking about 11% for this year, and next year it's mid-teens. Have they been scaled back from the start of the year? As in, at the start of this year, were you factoring in, say, 16, 17%, which has come down to 11%? Or for FY24, were you factoring in a higher number earlier? I just want to know whether you've scaled it back a little bit.
Yes, we have. At the start of FY23, our numbers for FY23 were more like in the 15-16% range. And we've seen cuts to mainly the consumer-related sectors, the commodity-related sectors where there's been cuts. But conversely, there have been upgrades for banks and the cap goods companies, for example. So they've done much better. But by and large, it's balanced out. The other big cuts have also been to the oil companies, the OMCs in particular, where we've seen much bigger losses than expected. And they also have a reasonable weight on in the index. But by and large, yes, we have seen cuts, and that's why the earnings growth outlook, while it's still better than most emerging markets, we're not sort of out of the woods completely as far as the earnings growth momentum is concerned.
Okay, the market is also picking up pace, right? I mean, saying I'm not done with my rally just yet. Look at the way it's moving now. 18,400, we're within kissing distance of that. And it's picking up pace quite a bit, actually. It's now at the highest point. The Nifty, the Sensex is up 104 points. And what's gaining ground this morning is metals. Hindalco, Tata Steel, JSW Steel, all zooming this morning. Hindalco is up almost about 5% And then a couple of these other names, Bajaj Auto, HDFC, looking pretty good. Pratik, I wanted your thoughts on autos. There's been a significant up move there. The management commentary is very positive across the board, barring, few pressure pockets. Which are the spaces that you still like here?
So autos, as you know, is pretty, you can't generalize. You have four-wheelers, two-wheelers, the auto ancillaries and so on. So generally, for the earlier part of this year, we were recommending the auto ancillaries, but most of them are export-oriented plays, especially to Europe and the US. And we are worried about a slowdown over there, more earnings cuts likely over there. So in general, we are shifting focus back to the OEMs. But even within the OEMs, not the passenger vehicle segment, Maruti, for example, we still think there's risk of more earnings downgrade. The valuations are still expensive. Margins haven't really recovered, and we still worry about more margin pressures going ahead. But it's really the commercial vehicle segment where, on a relative basis, we are slightly more positive, or the auto conglomerates like M&M, for example, where valuations are still somewhat attractive. But otherwise, in general, the auto sector is a mixed bag. Two-wheelers we don't like. We prefer more of the commercial vehicles and the tractor manufacturers.
Right. Pratik, with all of this sort of newly listed companies and their lock-ins opening up, what kind of, broadly, I'm just trying to get a feedback, because you would be speaking with so many of these funds and clients who are clients of yours. What's the feedback? Will all of this get done in a very orderly fashion? I mean, delivery, for example, right? I think the lock-in opens up on the 20th of this month. Some 30% of stock potentially can get sold. Perhaps not all of it will. So just your thoughts on this, not just delivery, but other businesses.
Sure, Prashant. Yes, at Kotak, we've been quite closely involved with many of these stocks where the lockups are expiring. And you're right, in the short term, there is a risk of a disorderly selling that can come about. If all the sellers who are locked up, they rush to sell the stock at the same time. But typically, in our experience, we've not seen that happen. Most of the sellers are not necessarily desperate sellers. That's point one. Second, they will potentially, and not everybody is looking to exit right away. Some of them, irrespective of the stock price, irrespective of the lockup expiring, they still want to hold on. So clearly, the promoters, the founders, and some of the key management personnel, and some of the longer-term oriented funds who invested, the lockup expiry in itself will not necessarily trigger a sell. However, there are clearly investors who've been inquiring and will be, closer to the lockup, depending on whether stocks are trading. You will see some selling pressure. So the short term, there is a risk of these stocks coming off slightly. But equally, I would say that on the buying side as well, we speak to both global and domestic institutional investors, many of whom actually like these businesses from a fundamental long-term perspective. They've just been waiting for this stock overhang to get out of the way. And hopefully they're looking for potential declines to buy these stocks. So they're all sort of waiting for a correction, waiting for a discount if an offer comes by. So you could actually see a spike in volume for sure. But I don't think it's fair to say that you will see a sharp decline necessarily. Some of these stocks have already come off quite sharply, either on expectations of the lockup expiry overhang or because of some fundamental factors like an earnings downgrade or something. So these stocks have already come off quite sharply. So I'm not sure you'll see too much of a decline from here on. For investors, I would say, go back to the basics. If you like the business from a longer term perspective, you should be buying these stocks as and when they hit your price points which appear attractive, and don't get too hassled by these lockup expiries, either to sell or to buy.
Sure.
You should ignore these technical factors.
Okay, ignore the technical factors. Look more at the fundamentals if you like the business and whether it makes sense to you, right? At the end of the day, most of these businesses still continue to be loss-making, although they have talked about a path to profitability. Thanks a lot for joining in, Pratik. Appreciate your thoughts. Well, for the market, it's quiet, but the mid-cap index is under a bit of pressure, so don't lose